Hi everyone. Today I'm excited to share another educational video with you. This time prepared by Maros, one of the most active members of our Tanuki trade community. After Ian's awesome video, Maros has also put together a presentation on the theoretical foundations of the RG multi-leg option strategy, which I believe will be a big help to anyone wanting to understand this approach better. A huge thanks to Maros for his contribution to the community, and now I'll hand it over to him.
Hello everyone, my name is Maros, I'm from Slovakia, Europe. When I first started making this video, I wanted to show you only the XSP trade itself. But the more I was into the video, the more I thought it may be more beneficial to show you a deep dive into it, my setup I use, my preparation before placing a trade, managing the trade, and closing the trade. But first things first. I'm not a financial or investment advisor, and nothing presented in this video is financial or investment advice. Also, I am not affiliated with Tanuki Trade or anyone else in any shape or form. I'm just a guy on the internet sharing my experience and my learning process of a trading strategy called multi-leg strategy, originally posted by JR on Discord. So please take everything what I'm giving with a grain of salt. Indicators which I use on the chart are of course Tanuki Trade GEX levels and GEX overlay, then 𝗹𝗲𝘃𝗲𝗃𝗀 cumulative delta and 𝗹𝗲𝘃 trend and pullback. Lastly, the GEX bot on the Discord. To model the whole trade and each next option leg, I'm using the web application OptionStrat and Risk Navigator tool in Trader Workstation by Interactive Brokers. I will not go into details about the rules of the multi-leg strategy, the backwardation rules, or explaining the Greeks. If you want to understand the basic rules, please watch Ian's video. He did a fantastic job with explaining them. The link should be in the description below. If you don't know much about options, the Greeks, and how the Greeks affect the whole trade, please learn them beforehand. They are essential to utilize the multi-leg strategy. There are a ton of good resources online which can teach you the basics of options and the Greeks. So if you lack the required knowledge, please do your due diligence, learn the basics, and please come back and watch the rest of the video so you can better understand what I will talk about. Another important thing about this strategy, and I cannot emphasize this enough, if you are intrigued and you want to try it out, please do it safely in a demo account first so that you don't lose your own money. I have said this before on Discord and I'm standing behind this statement. I strongly advise against testing this strategy on stock options if you don't have enough experience. With stock options, you are risking early assignment and that could be very, very costly. Please use this strategy on indexes like XSP or SPX. These are cash settled and there is no risk of early assignment. Lastly, this strategy requires a margin account and level 4 options permissions from your broker. To best leverage all of the strategy's strong sides, you would need to have a portfolio margin. Each broker has its own requirements for portfolio margins, so please check with your broker if you have the account size for it. Nevertheless, you can use this strategy on regular margin accounts with some limitations and adjustments. So, finally, with all of the information out of the way, let's get to the trade. As you know from the title, this specific trade was made on XSP index and was opened on 31st of March and planned to expire a week later on 7th of April. If I would summarize this trade, the trade itself was really difficult because the market made sharp and very volatile movements as a reaction to the tariff announcements in the United States. During the whole week of the trade, both break-evens were threatened and the trade needed constant watching and decision-making. So, what do I look for when opening the trade? Firstly, I'm deciding which expiration date to choose according to the backwardation rule. Hands down, the best duration for the trade is 2 weeks, which gives you enough time to manage it or correct mistakes if you made any. If the backwardation is favorable within a week's expiry, and I have more confidence and experience with this strategy, I can open a trade within a week's expiration. After that, I'm starting to look at the GEX levels on the chart for the expiration date. Again, for the expiration date. That will give me a rough idea where the market participants expect the boundaries of the market to be, and that also helps me decide which strike prices to choose. I'm preferring round numbers when opening the trade, but this mostly applies to SPX because they tend to have the best open interest and volume, which then translates to better bid-ask spreads and better fills. Then I'm double checking the GEX data with GEXBot on Discord, and not only I'm looking at the total gamma exposure on the expiration date, but also checking each weekday to get a more detailed view of gamma exposure. Of course, the data can and will change during the trade's lifetime, so checking them constantly is a very good idea. The GEX bot has a lot of advantages over the indicator on the chart because the bot gives me not only the GEX levels, but also the market sentiment through the net delta exposure and the open interest on each strike price. Without this information, I'm basically blind and would only guess where the market could be a week or two later or what the sentiment looks like on a specific date. When I have all of the mentioned information, I'm starting to modeling the trade on the Risk Navigator and OptionStrat, not only to get a nice view of the trade, but to also see what the trade Greeks look like. As stated in the rules, theta needs to be higher than vega to protect the trade from volatility swings. If you want to have a short vega or a long vega, that depends on your decision and on the market too, as well. For example, use short vega if you don't want to fight volatility drop in the middle of the trade. The GEX data from the chart on the GEX bot on Discord could really help you to make this decision. On OptionStrat, I don't really focus on the credit received for opening the trade. I focus mainly on the Greeks. Credit received is not that important because I know the credit received could easily change to debit paid during the trade lifetime when I make changes to it. And I know that the first two diagonal spreads are not the last option legs which I will open. So the initial credit received is not the final state of the trade. If you do not want to open another legs during the trade, but open only the first initial diagonal spread or spreads, then the credit received and risk to reward is important to watch too. When I am satisfied with the strike price selection and the Greek values, then I start focusing on the chart and wait for the indicators to show me the best possible entry to open the first diagonal spread according to the rules. As I have learned when opening this trade now several times, entries are really important. With a good entry, your diagonal spread starts to be in profit almost immediately. If you don't get a good entry, it's not the end of the world. Almost everything can be corrected, but it will be better for your trade that you get a good entry. The benefit of Risk Navigator is that you can immediately see all prices for all strikes you selected, their Greeks, the total delta, theta, and vega values of the whole trade before you even open it. Also, you can plan a what if scenario and ask the tool, what if the volatility changes? What if the price of the market is 10 points higher or lower? Or what if 2 days have passed, volatility dropped, and the market is down 10 points at the same time? How will this affect my trade, my Greeks, P&L, etc.? In this specific trade, I have opened two diagonal call spreads at the start because the market was constantly moving up and I was expecting a change in direction soon. After the down move finally, I have opened the put diagonal spread and the trade was put into neutral delta state. From this point on, I am starting to look for directional moves in the market to open another short leg to give the trade more premium, thus more profit potential. After that, I'm constantly monitoring market movement and adjusting positions as needed. In my opinion, managing the trade is the second hardest thing to do in this strategy. Here we can make the most mistakes. Emotions can kick in when the market makes sudden moves, or you freeze and do nothing, or you panic and do something you shouldn't. For those of you who watched my previous XSP trade on Discord, I have modeled several outcomes of the trade in Risk Navigator, but ultimately my brain got stuck only with one outcome and it couldn't let go of it, which in the end lost me the whole trade because I froze and didn't do anything. I'm sharing this with you because I made a mistake, and please don't make the same mistake as I did. That is the reason I'm relying on all of the indicators which I have mentioned in the beginning of the video to make better decisions and to stay calm in every situation. Instead of panicking, I'm trying to model all possible outcomes and prepare for them in Risk Navigator. The most important thing that helped me was keeping my head open and saying to myself, don't get stuck with only one idea. I would advise to open short legs as soon as possible to add more premium to the trade when the premiums have enough value. If you are opening the trade on Friday, I would add more premium as soon as possible, meaning on Monday or Tuesday. You can add more short legs on the following days too, but the premiums needs to be still high. The basic rules of the trade are stating to close the short option when it's in profit and open another one for more premium, or credit received if you will, as Ian stated in his video as well. But there is another option which has proven, at least for me, to be a better solution to keep margin in control in smaller accounts. I hope you guessed it by now, I'm talking about the famous box strategy. Boxing means to open a protective long option very close to a short option, which is in profit and you want to lock in that profit from the short option. Boxing is generally an arbitrage strategy, which in theory should be risk-free, and if the box is placed correctly, the legs which form the box should always generate profit, and it doesn't matter which direction the market takes. Basic rule about boxing is that the long option, which should cover a short option, needs to be cheaper than the original price of the short option it covers. Let me repeat that. The long option, which is covering the short option, needs to be cheaper than the original price of the short option it covers. Let me switch to option strat to demonstrate it to you. I have opened a short call at strike price 545 for, let's say, $10. Some time has passed, or the market made a quick sharp movement to the downside, which means theta is nicely decaying from the short option and it's in profit. Now I want to lock in that profit by opening a long call very close to the short call. In this case, I will demonstrate it by opening a long call 545 for 5 USD with the expiration a day after. And just to be very clear, I am not following the rules in this example with the expirations. I don't care that the long leg is not expiring on Monday and the short on Friday as it should be. It's really just for this demonstration. So let me open the long call. Now I'm changing the expiration day after, and now changing the price to $5. As you can see, I have opened the long call when the market moved down and the calls are cheap. This is crucial. The calls need to be cheap. I will not open this long call when the market made a move to the upside and calls are expensive. You can see now that both of my legs will generate profit and it doesn't matter where the market goes. So the cheaper the long option is, the more premium you will generally lock in. You can be neutral in the box, but you can also pick a direction of the box, meaning one side will be more profitable than the other. That decision is yours to make, and it's a hard one, because when the market goes the other direction, you are leaving a lot of potential profit on the table. If you have a neutral box, so the long option sits above the short option, the box will look like a sharp cone, and the most profit will be on top of that cone, which you may or may not hit at all. Let me demonstrate it. Let's change the price to $5 again. So you are now seeing the sharp cone and the most profit is in the middle. Creating the box could be hard because the market may not give you the opportunity to do so and may turn against you in a sharp movement. Then you need to be prepared for that possibility as well and have a strategy for that too. Let me now demonstrate a directional box to the downside or to the upside. So if I change the long call to 544 as it was and change it again to $5, you will see the more profit will be generated to the upside. If I instead open a long call 546, let's change it. Let's change the price to 5. You will see now the more profit will be captured to the downside. This decision, as I said again, this decision is on you and you only. Let me zoom out a little bit. If you have opened a new long option to box a short, you just gained, from the whole trade perspective, a free long option which can cover a new short option which you can sell to open. The long option can be the original one from the first diagonal spread. It doesn't matter which one it is. You have to keep that in mind. Let's talk about margin for a second. Why? Because if you open only a short option without a long option, this short is called naked short, which has a lot of margin requirements. But if you have a long option opened already, this will cover the margin required to open a new short. The amount of margin required to open a new short depends on how far away the long option is from the new short option. The closer to the long option it is, the less margin it will be required. So, if you repeat the boxing process on the new short, you will add more potential profit to the trade and can repeat the same process again and again and again. Open a new short, open a new long to box it. If you perform this strategy correctly, your margin will be under control and you are adding more potential profit to your trade. Now, with this information you have, you can understand the next move I have made in this trade. Let me switch back to the trade. The market was really rallying and has put the long call strikes 559 and 560 into profit. The rules of the trade also state if the longs are in profit, it's advisable to roll them for credit to keep their profit. By rolling those long options more out of the money, you are doing several things. First, locking the generated profit of the long legs. Second, reducing the cost of the new long legs. For example, if you bought the original legs for $5, the new ones will cost only $2.50. So that's lowering your risk if they potentially lose all its value and drop to zero. You will lose only 2.50 instead of 5. Third, this will increase your margin requirements because you are moving the long options further away from the shorts. So you have to keep that in mind. This is really crucial. 4, you are opening a possibility to box the shorts if the market gives you that opportunity. After the initial rally, the market finally turned down, giving me the possibility to open long calls 560 and 562, boxing both of the short calls 558 and 559. With a downside move and with 2 new long calls opened, I had the calls 570 and 571, the ones which I rolled into, free to cover new short calls if the opportunity will arise. And I took the advantage of that and opened one short call 565 to gain more potential profit to the trade. When the market moved down, I expected a change in direction, so I opened a new put diagonal spread 550 552. But the market had other plans and started to move down sharply and started to breach my left break even, so I had no choice but to follow the trade rules and open a in the money long put, which I did. That was the long put 545. The market moved down 30 points sharply, so if I didn't do anything, my short put 548 and 552 would have generated unlimited losses. That's why following the trade rules saved my trade. That long 545 put was a very good move because I have put my whole trade into box, protecting all of the break-evens, and it was the most profitable leg of the entire trade. In the end, I have made $2,269 in profit, with all break-evens being threatened at some point. And if it wasn't enough, the market made a sharp move 30 points down. The long put was 750 USD in profit, which was 77% of the whole trade's profit. In this picture, you can better visualize the left break-even being saved by the 545 long put. I don't know if it's entirely visible, but the market was at the level 520, so You see, if I didn't do anything, my whole trade would be at loss, and a huge loss. The last step of each trade is to close it. And this stage, at least for me, is the hardest part of the trade. Why? You have to watch several things. One of them are margin requirements. They tend to exponentially increase in the final hours of the trade because gamma will be on steroids, and each one USD move of the market will make significant changes in option prices, and margin can get out of the hand. Second is to decide which leg to close first if you want to achieve maximum possible amount of profit. So that's a constant play as a cat and mouse with the market, hoping the market will move as you want, so you can close the legs for maximum profit and also still keep margin under control. At this stage, your emotions can also kick in. You can panic, get out of positions too soon, close them at a loss, even if you would have waited, they could be at profit, etc. So it's a constant battle in yourself to keep emotions in check and try to stay calm, not to panic, close too soon or too late. Decision making is really the hardest part in trading. Thank you all for sticking with me to the end. I hope you have learned something. I would like to take this opportunity and express my gratitude to JR for sharing his knowledge and know-how with the Tenyuki trader community. His strategy is one of the best I've seen, and start using it made me develop patience, clear head, and most importantly, how not to panic. Secondly, I would like to thank Greg, who kindly added XSP gamma levels to the chart and to the GEXBot, especially for this video. That made this trade a lot easier, so thank you again. Lastly, I would like to thank Ian for making the first video, from which I have learned a lot as well. I would like to also thank the entire Tenyuki trader community for everything, for the questions, pushbacks, and support. Together, we all learn from each other. Thank you.
Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.